Hello, welcome to Morris Money, where we give you stock tips in under 5 minutes. I'm your host, Morris Willie. What's wrong? I didn't say it yet. Today, I'm talking about why gold could be a smart buy during inflation periods. Buying gold is a smart way to add stability to a diverse portfolio, especially if you're looking for a hedge against inflation. There are several ways to buy gold, from physical gold and miners stocks to gold IRAs and other forms of the precious metal. Perhaps the easiest way to purchase the yellow metal is to buy shares of gold exchange traded funds, or ETFs, saving you the trouble of storing it. As it has been for thousands of years, gold remains a valuable commodity today. Investors and non-investors alike buy gold for unique benefits. For one, buying and holding gold is easy. You don't have to worry about earnings reports, dividends, payments, and other features. Its main job is simple: store value for you long term. It's this primary benefit that attracts those looking for a safe haven for their money in uncertain times. With rising inflation and fears of a looming recession, now may be a good time to invest in gold. Some of you may be asking, how and why does gold act as an inflation hedge? Well, gold tends to hold its value for longer than many other asset types. As such, it can act as an inflation hedge when buying power decreases. Inflation has been the story of 2022, hitting a 40-year record in June, with consumer prices rising 9.1% year over year across numerous sectors. The most recent Consumer Price Index reports prices for goods and services rising 8.2% this September over the previous 12 months. Meanwhile, the Federal Reserve is following an aggressive interest rate hike schedule this year. The benchmark rate is currently 3% to 3.25%. That's a significant spike from the 0% to 0.25% levels 1 year ago. But it doesn't keep pace with the rate of inflation over that period. Consider this. The 1970s was a decade of inflation, starting with an average interest rate of 5.84% in 1970 and ending with a whopping average rate of 13.58% in 1980. During the same period, the value of gold soared from $35 per share to $850 per share, according to NASDAQ data. Like other asset classes, gold may not continue to follow the same past trends, and it's impossible to know whether its price will rise or fall. Still, many investors view gold as a hedge based on its past performance in inflationary environments. What's the bottom line here? Precious metals like gold and silver are often seen as a hedge against inflation because they preserve their purchasing power for long periods of time. So while stocks and other assets may experience large fluctuations, the price of gold may be more stable. Gold can be volatile in the short term, and it generally doesn't appreciate the same as a stock or bond does over the long term. As a result, financial advisors often recommend investing no more than 10% of your savings in gold. So I'm going to pass the question off to you. Are you buying gold during this time, or potentially silver? Me personally, I'm more of a silver type of guy, but I have nothing against gold, and I might start looking into it to invest in during these periods. It could also be a good idea to try to invest in gold mining companies or, like I said earlier, gold ETFs, like the one I have up on the screen, Barrick Gold, ticker symbol GOLD. Finally, if you want to see more precious metal content from Morris Money, let me know below, because I wouldn't mind digging deeper into precious metals, because it's a topic I don't talk about enough on the channel. So let me know if you want to see some more precious metal content down below. Please don't take this video as financial advice, and thank you for watching Morris Money.